If I told you that one tiny company could be about to change the energy industry forever and that it's trading for just $1, would you be intrigued? This little-known Aussie company says it's found a way to transform fossil fuels into clean energy. Think about that for a second. That's huge. Currently, this company is so small that hardly anyone knows about it, which is why its stock is still so cheap. And that means there's the potential for incredible returns if and when this company's tech goes mainstream. This clean energy breakthrough stock is just one of 7 promising Aussie companies on our radar at the moment. To get the full details on all of them, click the link below now.
G'day there and welcome to the closing bell on the 20th of November. Today I'm going to have a look at the US bonds. I have looked at them a while ago for you, but I think we're just getting to a period here where there is heightened risk that these US bonds could sell off. So I just want to set up for you the big picture in those bonds, how they're looking to me, and give you a few ideas on how you could play it to really hedge your portfolio in case that sort of outcome happens. It's a dangerous trade going short the US bonds. There's no doubt about that. But I just think the risk reward situation is getting nearer to a point where the downside's limited and your upside is pretty huge by shorting these bonds. And look, if equities get drilled on the back of bonds selling off, it'd be nice to be short those bonds to soften the blow a little bit, I think. So let's have a look at the US 10-year bond yield chart first, and then I'll show you a couple of ETFs that I think could be worth checking out. So here is the US 10-year bond yield chart. So that means when the yield's going up, the price of the bond is going down. When the yield's going down, the price of the bond is going up. So it's a bit of a confusing one, but basically when you see this yield going up like this, that means the bonds are selling off because the yields are rising. They move inversely to each other. And this chart is looking at nearly 10 years worth of data. And the first thing to point out is that widening distribution. This is one of the key things I look out for when I'm looking for opportunities, where you've got an initial range set up, and then we have lots of work done around that range. False breaks of the edge of the range, with a move back to the point of control, which is the midpoint of that range. And then it's happening again, breaks out to the upside, tries to breach above 3%, but then gets sucked back into the range, back to the point of control. And in the last year with the COVID crash, the yields really plunging to near zero, to around 0.3% for a 10-year bond yield, which is a pretty crazy low yield, isn't it? And the thing I want to point out is that area 1.618 outside the range. Now that is a very key area for me outside a range. That's when people are saying that the range is definitely done and dusted, but it is a point where if you find support there, that can be where a reversal can happen. So looking at that, you can see we've hit that 0.3 level exactly in that COVID crash and has turned back up with yields racing up to that 1.8% level. And the next thing I want to point out for you is the fact that the 10-month exponential has crossed above the 20-month simple. So that long-term trend has shifted for me on those yields. You can see over the last 10 years or so, it's been a pretty good indicator, hasn't it? Just the moving averages to give you a sense of the movement in those yields. A big rally, crosses there, big sell-off for a few years, crosses there, big rally for a few years, crosses there, big sell-off. And here we are in those early stages of the trending yields going up. And I like to see after a trend shift, a move back to retest the moving averages. And then if things kick back up to the upside from there, it's often a pretty good wave to the upside. We can see in the past, this is back in 2017, we've got the initial kick higher. We then have the retest of the long-term moving averages. You can see there. And then once it kicks higher, that was that next leg up. And so it's looking very similar to me. And the other thing that I'm really focused on is the fact that it's re-entering that big range that we've been in for the past decade. And re-entering that range, for me, above that 1.8% level, it can be a pretty quick trip back to the point of control, which is around 2.2%. You'll see again in the past, we had a little false break here. Once it really returned into the range, boom, it was very quick to that point of control. And again here, once it busted up, pretty slow there. And then 2 months, it was back at the point of control and really collapsing. So that's just where I'm seeing the setup at the moment, is that there's just lots of boxes ticked. With this drop in yields we had in the middle of the year, you can see that there's been a monthly buy pivot on the yields. So that happened a few months ago. That was that candle there, with the close on the month above the high of the lowest price candle. So that says the candles on the monthly have actually turned back up as well. So pretty much everything is pointing up on these yields. We have the trend has turned up on the moving averages. We have that distribution saying that yields are going back into the range of the past 10 years. We have the candles on the monthly have turned up. So even though we had that rally in yields after taper was announced, technically everything is still saying that these yields could still be heading higher. And for me, it is the breach of above that 1.8% region. But I'm actually getting signals around here, which are saying you could start entering a position short these bonds. And look, you could, get out if yields head back below 1%, for example, which would be below that low of the rally mid-year. So the way I'm looking at this is that there's a lot of risk if bonds do sell off, but I can't see bonds rallying very far in the 10 years with inflation up through 6% and still not having topped out and really looking like it's going to be not transitory. So I just can't see those 10-year bond yields rallying far, even if they do rally a bit. So let's move on to how we could play this. So the markets that I'm looking at are a couple of ETFs. One of them is PST, which is basically leveraged double short the US 10-year bond. So that one, if the US bonds do sell off, the price of that will go up quite rapidly. And this one is sitting around $16.33 for that. And look, you'd have to have an international trading account, I think, to access. I don't know whether you can access it via CFDs. Maybe you can, those ETFs in the US. But this one, you can see, very similar to the US 10-year bond yield chart where the monthly trend has turned. But because this is doubly leveraged, you can see that the range from years ago, we're way below that in price because of the leverage inherent in the ETF itself. So the price will move quite rapidly. But, looking at this sort of thing, if you're buying it at 16.33, possibly you could even have a stop loss, either below the low mid-year or even below the low of the whole lot, below $15, and just have a position where you're saying that, this is the risk, is that things could go a bit pear-shaped. And if that happens, equities will sell off. Bonds, if bonds are selling off, the price of this will go up quite rapidly, which will just lower your overall risk in your portfolio. So that's the first one that I'm looking at, thinking might be worth having a stab at. And the other one is, and this is a 20-year bear ETF, which is 3 times leveraged. So this thing is going to move very rapidly, but that increases the risk. So that means, if bonds do rally, the price of this thing could go down quite rapidly. So you're not putting your house into this thing. You don't need to put that much money into it to really reap quite a big benefit if the bonds do sell off. And the price of this thing is down around 57, 67. But you can see in the last year, a couple of years from 2018 through to 2020, it's gone from a price of $240 down to a low of about $40 or $50. So that has really collapsed. And if you look at the long term of it, you can imagine it's been possibly the worst investment anyone could ever have made. If you look at the price of this thing, let's have a look at it. Going back a long way, anyone who's bought this product has pretty much lost money. And that's why I called it the Widowmaker trade, trying to short the US bonds. Plenty of people have tried and most or everyone has failed. So it's a toughie. But I just think with the way that inflation is looking, this sort of a left field idea to manage the risk in your portfolio, the time for it may be coming. And there's a couple of good products out there. There's a few other ETFs out there that are worth looking at. But I just think the ones I've looked at, that PST and TMV, they're two that I'm certainly having a close look at, and you might find them interesting as well. Do a bit of research into them and think about them, but they are high risk. But I think if the bonds sell off, that will be a really nice way to hedge risk in your portfolio. So that's really it for this week. I think it's not a bad time to be thinking about that sort of thing. It'll be interesting if these inflation figures get worse over the next month or two. I think the Fed's going to get a lot of pressure on them to really increase the pace of their taper. And if that starts happening, the market will react. So I think the market isn't positioned for this inflation to get worse, and we could see some real fireworks in the markets out there, and the US bonds is the area that I'm looking at where I think the fireworks could ignite. So anyway, that's it for this week. I really hope you enjoy the video. Make sure you press the like button down there if you do like it, just below the video, and join up. Why not subscribe to this so you get notifications? You press that little bell, and then you'll just be subscribed and get notified when I'm releasing the videos. And definitely check out my services, Australian Small-Cap Investigator and Pivot Trader. You just press on the title of the video. I actually found this hard, being an old bugger. You just press on the title of the video below, and a whole lot of stuff will pop up showing you lots of information. So if you've found it hard to find the information, that's where it is. All right, well, I'll finish up, and I'll come back with more next week. Cheers.